The confirmation email arrives on a Thursday. You are sitting at a kitchen table in an apartment that still has boxes in the corner from a move you made 14 months ago. The screen says your account balance is $500. Not $500. $500. The decimal matters to you tonight in a way it did not this morning. You read the email twice, then a third time. Nothing in it tells you what happens next. There is a number on the screen and your name above it, and a logo you do not fully trust yet. The refrigerator hums. You close the laptop. The account being open does not feel like anything. You expected something to shift, a feeling of having started. What you feel instead is the specific flatness of a decision that has no immediate consequence. The $500 will sit there tonight. It will sit there tomorrow. The market will open Friday morning, and your $500 will move 11 cents in one direction or the other, and you will not notice because you will be doing something else entirely. You are 34. That number means something specific. Not because of where you are, because of where the math is. At 23, you had an income. It was not large. $31,400 a year, which, after taxes, landed closer to $26,200, which, after rent and a car payment, left something. Not nothing. Something. You did not invest it. The math does not adjust for usual. If you had put $190 a month into a basic index fund starting at 23, and if that fund returned 8.1% annually, you would be arriving at this Thursday with $74,600 already sitting somewhere. You are not arriving with $74,600. You are arriving with $500. The difference is not $74,100. The difference is 11 years. 11 years of compounding that started without you and ran its full course and ended at zero because the account never existed. There is a man named Gerald who works in the office 2 floors above yours. He is 54. He keeps a coffee mug on his desk that says nothing, just a solid blue color, slightly faded. He started at 22. You have had this information about Gerald for 3 years and done nothing with it. That is the first place something goes quietly wrong. Not when you spent the money. When you heard the information and felt it did not yet apply to you. It applied at 23. The clock does not have a snooze function. The $500 felt like the decision. It was not the decision. You made the account. You funded it once. And now you are waiting to see what it does. The deposit is not the variable that determines what you retire with. The monthly contribution rate is. You have a coworker named Diane. She opened an account at 35 with $200. She set a recurring transfer of $200 a month and did not think about it again the way you do not think about your electric bill. She is 61 now. Her account has $187,400 in it. You have another coworker. Same age as Diane when she started. Same starting deposit. He set his recurring transfer at $400 a month. He is also 61. His account has $374,900 in it. Same starting age, same market, same fund. The only difference is a number Diane could have changed on a Tuesday afternoon in 4 minutes and never did. The first deposit is not the architecture. It is the address. The architecture is the monthly number you set inside the account after the account exists. Right now, your architecture is $0 per month. The $500 is sitting in a money market holding position, earning 41 cents a day. It is waiting for an instruction you have not yet given it. The instruction is not which stock to pick. The instruction is how much arrives here every month without you having to decide again. You do not build wealth from a single deposit. You build it from a number small enough to forget and consistent enough to matter. $200 a month starting now produces something. $0 a month starting now produces $500.41 and a false sense of having begun. Account balance is now $500.41. 14 months after you open the account, the market drops. Not a little. Your balance falls from $4,200 to $2,940 in 11 trading days. You check it on a Monday morning before work, standing in a kitchen with a coffee cup you have not yet lifted to your mouth. The number looks wrong. Not wrong like a mistake. Wrong like a door you did not know could open in that direction. You read 3 articles that afternoon. 2 of them say sell. 1 of them says nothing, just shows a chart going down with no indication of where the bottom is. You do not sell, not because you are disciplined, because you are slightly frozen, and the friction of logging back in and finding the sell button is just enough to stop you. This is the accidental version of the right decision. A man named Philip sold in March of 2009. His balance was $38,200 before the drop. It fell to $24,100 and he sold everything into cash. The market recovered fully 19 months later. Philip's account in that same period went from $24,100 to $24,100. He was waiting for the right moment to get back in. The right moment did not announce itself. It passed on a Wednesday while he was doing something else. Your account at the bottom reads $2,940. You leave it there. You feel uncomfortable in the specific way of someone who has made no decision and is unsure if that is wisdom or paralysis. 19 months later, your balance is $6,100. Not because you did something, because you did not. The loss is not the danger. The reaction to the loss is. Account balance is now $6,100. You are 44, and the account has $81,400 in it. You did not check it every week to get here. You checked it sometimes. You left it mostly alone. The $300 a month you set up 22 months after opening the account has been transferring quietly on the 14th of every month since. You barely notice it leave your checking account anymore. There is a statement on the corner of your desk, printed because your accountant asked for it. The paper slightly warm from the printer. $81,400. You look at it the way you look at something that does not quite feel like yours yet. The problem has changed shape. At 34, the problem was starting. At 44, the problem is what this number is actually for. $81,400 at 44 is not retirement money yet. It is a decision maker. The balance you carry into 58 determines whether you can leave a job you no longer want to do. Not whether you are rich, whether you have a choice. The account is not a savings account. It is a future negotiation you are having with a version of yourself you have not met yet. That version is 58. He is sitting somewhere making a decision. The size of that decision depends entirely on what you do between now and then. Not in a dramatic way, in a monthly transfer way. Account balance is now $81,400. The confirmation email is still in your inbox. You never deleted it. It is sitting between a promotional offer from a mattress company and a calendar reminder you never cleared. The timestamp says Thursday. The balance in the email says $500. You are 58 now, and the account has $312,800 in it. You did not get there from a raise. You did not get there from a bonus or an inheritance or a single correct decision made under pressure. You got there from a Thursday, and then from every quiet Tuesday and Wednesday after that, when you did nothing except leave the account alone. The refrigerator hums in a different kitchen now. Different city, same sound. You find the email not because you were looking for it, because you were searching for something else and it surfaced. You read it once. Your name at the top. The logo you did not fully trust. $500. You do not feel the distance between that number and $312,800 as pride. You feel it as time. Specifically as the time you almost did not start. The account did not change your life the night you opened it. It changed your life on the mornings you woke up and thought about something else entirely. $500 was not the beginning of a fortune. It was the beginning of a Thursday that kept going.